In the year 2000, Enron was one of the most valuable companies in America. Analysts praised it, investors trusted it, business schools studied it. But Enron wasn't famous for a product you could point to. It was famous for an idea. The idea that it had figured out the future. And when belief becomes more important than reality, collapse is only a matter of time. Enron didn't begin as a scam. It started as a straightforward natural gas pipeline company. Steady business, predictable profits, nothing exciting. Then, in the 1990s, energy markets were deregulated. Enron's leadership saw an opportunity. Instead of just transporting energy, they could trade energy contracts, promises about future supply and demand. Energy would behave like a financial asset, and Enron would control the marketplace. Under CEO Ken Lay and executive Jeff Skilling, Enron rebranded itself not as an energy company, but as a technology-driven trading powerhouse. Wall Street loved the story. The business became more complex, not clearer. But complexity sounded intelligent. Analysts admitted they didn't fully understand Enron, yet still recommended the stock. Enron wasn't selling energy anymore. It was selling confidence. This is where the illusion became dangerous. Enron used mark-to-market accounting. If Enron signed a long-term contract, it immediately booked all the estimated future profit. Not cash, not performance, just projections. If those projections later failed, losses should have appeared, but Enron didn't want losses on its books. So it built a way to hide them. Enron created special outside entities to absorb bad deals and debt. On paper, these entities were separate. In reality, they were controlled by Enron insiders. Losses disappeared, debt vanished. Financial statements looked strong. Even worse, Enron's CFO personally profited from these structures. The system rewarded deception and punished anyone who asked questions. Inside Enron, employees were ranked aggressively. Those who questioned numbers were pushed out. Those who boosted short-term results were promoted. Banks approved the deals. Auditors signed off. A whistleblower warned leadership the company could collapse in scandal. Leadership treated it as a public relations issue. Soon after, the CEO abruptly resigned. Once journalists and analysts dug deeper, everything unraveled quickly. Hidden debts surfaced, earnings were restated, trust evaporated. The stock collapsed, employees lost jobs and retirement savings. Executives had already cashed out. Enron filed for bankruptcy in 2001. Its auditor, Arthur Andersen, collapsed soon after for destroying evidence. New laws followed, including Sarbanes-Oxley. But the real lesson wasn't legal. Enron didn't collapse because people were stupid. It collapsed because people wanted to believe. And in finance, believing a good story can be more dangerous than facing an uncomfortable truth.